Looking at the markets today, we are seeing a massive synchronized sell-off. The Dow is down 500 points, while the Nasdaq has shed more than 2% of its value in a single morning. This isn't typical market volatility. It's a moment where external geopolitical and economic pressures are beginning to outweigh the tech sector's long-term projections. The first pressure point is coming from the Red Sea. A Saudi tanker carrying over 700,000 barrels of oil was struck by Houthi rebels, causing crude oil to spike 5% to over $91 a barrel. Simultaneously, 10-year Treasury yields have surged to 4.71%, the highest level since January 2025. This suggests that the cost of borrowing is becoming a primary concern for investors once again. Between soaring energy costs and rising rates, the market's patience is wearing thin. Investors are moving away from speculative growth and demanding immediate financial proof. This demand for immediate profit is clashing directly with the second quarter realities of companies like Alphabet and Tesla. This chart tracks free cash flow, the actual money a company has left over after paying its bills. Despite their massive size, both companies are now dipping into the red on this metric. This cash deficit is the result of a deliberate choice. These giants are pouring billions into AI infrastructure to secure their future market position. This creates a structural tension. Wall Street is looking for liquidity and survival metrics right now, while big tech is draining its cash reserves to build a world that doesn't yet exist. To understand this gamble, look at capital expenditure, or Capex, the money spent on physical infrastructure like data centers to run software. Alphabet alone will spend up to $258 billion on AI infrastructure next year to handle the computing power AI requires. This spending is transforming the entire hardware market. In 2002, the semiconductor industry was worth $2 trillion. Today, that valuation has exploded to $20 trillion. We see this in partnerships like the multi-billion-dollar deal between AMD and Anthropic. This agreement locks in 2 gigawatts of computing power, funneling billions more into physical hardware. The current AI era is currently defined by a cycle of extreme spending. The entire boom is predicated on the idea that this infrastructure will eventually pay for itself. This same aggressive strategy is being applied to the space sector by figures like Elon Musk, who is pushing the boundaries of what infrastructure spending can achieve. Major investors like Cathie Wood continue to double down on this vision, recently allocating another $80 million to SpaceX, despite the broader market pressure. This chart compares company valuations. While the average S&P 500 company trades at 3 times its sales, SpaceX is currently trading at roughly 80 times sales. To justify that price, the company is promising a future defined by orbital data centers and a global Starlink telecom monopoly. These are goals that require massive, ongoing capital to reach orbit. However, history shows how quickly investors can turn on this narrative. We saw it happen with IBM just last week. IBM shares plummeted 25% in a single day, their worst performance ever, simply because management noted that their customers were starting to shift their spending habits away from traditional services. If the market begins to doubt that these massive investments in orbital hardware and AI models will result in immediate profits, the $20 trillion Capex cycle could shatter. The technology market is moving out of its speculative phase and into a period where results are the only metric that matters. There is a growing reluctance to fund companies that are losing $25 million collectively each day, without a clear path to turning that spending into revenue. While major tech indices experience sharp fluctuations, several traditional sectors have been trending upward with far less volatility. Energy infrastructure is a primary example. The sector is up 30% this year, fueled by the fact that the US is exporting more liquefied natural gas to Europe than ever before. Even legacy names like Johnson & Johnson have outperformed many tech darlings, rising 50% over the last year, while consistently paying out dividends to their shareholders. In this environment of high geopolitical tension and rising interest rates, the market is no longer pricing in the possibilities of the distant future. It is looking for the profits of the present.